Okay, well, we're live now, so we just want to welcome all of our guests and apologize for a bit of the delay we've had here. We've got a bunch of technical difficulties here on our end. Not able to get our video presentation up, but we are able to bring the slides up for our presenters today. So unfortunately, you won't be able to get to see our smiling faces. We spent all this time in hair and makeup, and you guys aren't going to get to see us. But what we have here is this is the Tower Wealth Advisory webcast series. I'm here myself, Tyler Cobain, with Dave Cooper. We are Tower Wealth Advisory and Wellington Altus Private Wealth. We're here with Trez Capital and Mr. John Hutchinson, who's speaking in regards to the private commercial real estate and equity financing work that they do down in the United States. John is the vice chairman and global head of organization. So before of origination, and that's the origination of loans and equity financing in the U.S. Before I butcher the introduction any further, John, Dave and I'd like to turn it over to Spencer Hurley, who's also on the call with us. Spencer is our local associate vice president of sales here in Alberta. Spencer's been a great resource for us here in our office, and I'll let Spencer maybe do a bit of an introduction to Trez as well as to our speaker, John, today. So, Spencer, if you're able to, maybe you can jump on and do a quick intro.
First of all, thank you very much for having us on today. I think we're pretty excited to be here. I know I am. John has been with Trez for just over 10 years now in the role of leading our Dallas office, but he spent about 20 years in the home building business prior to joining Trez, where he was the president of the Dallas division of Ryland Group, which is a large developer, and they developed in his time. He was in charge of the construction of over 11,000 homes and development of more than 5,000 lots through that time. At his time at Trez, he has been the head of our Dallas office, where he's been in charge of a lot of that origination. They do mostly focus on the multi-residential and residential development side of things. Now, we've started to expand a lot recently in the past, call it 5 to 7 years, into more of the equity side of things as well. So I mean, I don't think that there are many people that have as much knowledge about the U.S. real estate market as John. So he's definitely a good person to talk to about this. So now he is covering all of North America for us as the head of origination. Without further ado.
Thank you, Spencer. Hello, everyone. Thanks for tuning in. As Spencer said, I joined Trez, started working with Trez about 10 years ago. It was actually 2010. I met Morley Green in 1994 before he started Trez. As you may know, he started Trez in 1997. I've had several titles in my career. I was an attorney for quite a while. Then I went into the home building business. And then I saw an opportunity here, and when I wanted to leave Ryland in 2009, and I called Morley, and I said, "There's opportunity down here. There's not a lot of money in the market, and there's opportunities to make loans and do things." In that time, we were strictly in Texas, and since then, we've out of our office here in Dallas, we've grown from myself just working alone with the Canadian offices to now we have over 20 people here in Dallas, and we've generated over $5 billion in loans since I started working with Trez. In 2012, I became a partner in the Dallas operation. We formed a partnership. We formalized our relationship. And then last year, with the reorganization of the company, Morley and I are the partners in Trez at the moment, although we'll be adding some new partners in the relatively near future. So it's been a great experience, and we hit the market at the right time and getting in here, in 2010 and starting to make loans. I've been in Texas since 1978. I grew up in Buffalo, New York, and moved here to work as an attorney in 1978. All of that time I've lived in Dallas, Fort Worth, except 2 years I lived in Houston in the mid-90s when I was president of a large home builder in the Houston market. So our focus has been, and I expect it will continue to be, in residential-oriented projects. We have one of the things that we'll get into is growth. It's all about growth, and we focus on high growth markets. not just Texas, but Arizona, Nevada, Colorado, Florida, the Carolinas. And we have offices in a number of cities. So we have the so-called boots on the ground all over the United States. We have an office in New York. We have an office in Atlanta. We have an office in West Palm Beach, Florida. Of course, we have an office in Dallas, and we have an office in Los Angeles, and we have an office in Seattle. We moved five of our team from Vancouver to Seattle to work to focus on the Pacific Northwest, which, as you may know, is a very high growth market with all the high tech companies in the Seattle and Portland area. And so we moved them from Vancouver to Seattle so that they could more easily focus without having to, cross-border issues and all those things. So we have a lot of breadth here in the United States, and we're, generating quite a bit of business, but our focus is primarily on residential oriented. Let me explain what I mean by that. We are a financier of lot development throughout the United States, in the high growth cities in the United States. We don't, do any in most of the northern cities, but we finance the development of lots, which are then sold to home builders who will build homes and sell them. We also finance a lot of apartment construction throughout the southern and southeast United States. And we also, there's also this new product, build for rent product. I don't know if that's starting to be a big thing up in Canada, but it certainly is here. And there's several components to it. One is building houses in a whole neighborhood of rental houses on platted lots. And we finance that type of project. And then there's another that we've done a lot of with. We were one of the early adopters of this, and we have financed some of the biggest developers of this product in the country, and that's called horizontal apartments, which are platted as an apartment project, but they build detached apartments, one-story duplexes for one bedroom apartments, and the 2-bedroom and 3-bedroom apartments are totally detached. So if you can envision little cottages, gated, say maybe 200 of them, and with modest amenities, and they're never intended to be sold individually like a house on a platted lot would be, but that's been a very, very popular product, and we have financed probably 25 projects of that nature throughout the United States. So we're heavily into residential. Well, in Florida, we do a lot of condo loans, high-rise condos. I've only done a couple here in Texas. Condos aren't as prevalent as they are in Florida, as you might imagine, but we'll do some of that. So that's our focus. We do a little bit of retail, financing on retail, not very much. We do a little bit of office, but the vast majority of our work, fortunately, is in residential. Now, when COVID hit, we were all afraid, well, my goodness, nobody's going to buy a house. And that was our fear. It lasted for only about 6 weeks. And then the dam broke and people started buying houses like crazy. And there was a lot of things happening there. The interest rates were lower, and people were wanting to moving to the suburbs away from more densely populated areas, and they wanted more space, and they were working from home, and all of that had an impact. And I was in, as Spencer said, I was in the home building business for almost 20 years. Never in that 20 years did home builders not sell homes voluntarily. But it got to the point where builders had to stop selling houses because they couldn't keep up production with the pace of sales. So that has slowed down a little bit. It was at fever pitch for a while. Now it's still, the market is very strong, but it's thankfully slowed down a little bit. The builders are putting limitations on how many houses they'll sell in a particular neighborhood so that they can monitor their production a little bit more closely. Costs, as you know, you probably heard, are going up. So they don't want to get so far ahead on sales that their costs are too high. So a lot of the builders won't sell a house until it's almost fully built, when they know with more certainty what their costs are. But the market, as I said, it's about growth. And we'll focus on Texas for a minute. The first slide is, it's got 20 years history, or a little bit more than that, of U.S. and Texas population and employment growth. As you can see, the population growth in Texas is since 1920, or since 2000, is virtually double in every year, at least double what it is in the United States. And that is, this is continuing. Now, Texas, the story in Texas, as you may be familiar with, the Texas story is it's lightly regulated, no state income tax. It's the quote leading red state, and it's versus California. We'll get to some numbers that are pretty compelling here in a minute, where people are leaving highly regulated, high tax state, and they're raising their income tax rate again, I think, in California. So you can, and housing it's very, very expensive in California, and it's more expensive now in Texas than it was 2 or 3 years ago, but still very affordable relative to the coastal cities like New York and LA and San Francisco, and we benefit and employers are moving here. It's every day virtually you read in the paper about some employer moving here, many of them from California. Texas leads the country in relocations from California of companies. So it's, like I said, it's an easier state to do business in. It's an easier state to start up a business, and living costs here are less. So it is attracting people, and it has for a long time. That was one of my kind of founding principles when I joined with Trez, is that we're gonna focus on Texas starting out because of the growth here. In Texas, you have about 27, 28 million people. It has a higher GDP than Canada. It is so Morley noticed that in Texas, if you take the triangle of Dallas, Houston, and then San Antonio and Austin as your triangle, there's about 18 to 20 million people in that triangle. And, that creates a lot of need for real estate development. Whereas in Canada, you're such a big country that to go from Vancouver to Toronto is, 5.5 hour flight. Whereas in that triangle, you can get to all those cities within 1 hour on an airplane. So it serves, it serves the business community very well to all that activity in that triangle. So we started in Texas. Still a big part of our business is still in Texas, but over the years we've branched out into Phoenix, and in Denver and Utah, Salt Lake City, Boise, the Florida cities, the Carolina cities. Let's go to the next slide. This shows you some migration. This is in migration, or if it's in brackets, out migration from 2010 to 2020. DFW led the country in migration. This is people coming in from other states, 763,000 people, roughly. New York was just the opposite. It lost by out-migration 778,000 people. And now you can see all of those cities in the lower right, starting with San Jose. Most of them are, well, not all of them, but many of them are in the north. And then you have New York and LA at the bottom three there. So Houston gained 644,000 people. Chicago lost 518,000. And Phoenix gained 601, and Los Angeles lost 512. Now, a lot of those people are leaving Los Angeles. A lot of them moved to Phoenix. Phoenix is just incredibly busy. Job growth is just tremendous there, and cost of housing is much lower than California. So people are abandoning California and in many cases moving to Phoenix or moving to Dallas, Fort Worth, or some of the other cities that are up there. A lot of the people that are moving to Miami are coming out of the Northeast, the New York, Connecticut area, New Jersey area. So you can see where migration is and where out migration is. And the one thing that I'm not trying to be glib, but I said, people have to live somewhere. And when they move, they have to have a place to live. And they're either going to live in an apartment, or they're going to buy a house, or they're going to rent a house. And we're in all of those areas. We finance housing, single family lots that serve the home building business, and we finance apartments, and we finance build to rent projects. So it's been a very robust time for us. In 2019, we generated in my office over $1 billion in loans. And in 2020, we generated about 600 million. That was in large part because of COVID. There was a period of time when we stopped financing projects until we got a handle on the market. Last year, we did over $1.5 billion in loans, $1.525 billion to be exact, in loan origination from our Dallas office. That was about equal to the rest of the company combined. So we're very active, and we look for growth, and we have all sorts of statistics that we follow about where growth is and where it's going. You can go to the next slide. This is more of a visual, of what was on the prior chart. You take the 4 Texas cities, you can see them on the graph, and then you look at the Los Angeles, Chicago, New York, and the decline in population over that 10-year period. So it's very significant, and it's continuing. It's not slowing down. The movement is, if anything, it's picking up, and with everything going on with COVID and the mandates that some states have, I don't want to get into politics, but some people don't like that, so they leave, and they come to Texas, where we have not been as I don't know, that the mandates here have been very light. Same thing in Florida, same thing in a lot of the other cities and states that we do business in. So people are more able to live their life as they did before COVID. The next slide's an interesting slide, and this gets into some things. This is from the National Retail Federation. Cities affected by organized retail crime. As you may have heard in our country, I don't think it's happening in your country, thank goodness. We have cities that are not enforcing the law, that are letting people run wild, looting retail stores. And this is the rank of the worst 10 based on the Retail Federation and where they're suffering the most losses. You can see that, not surprising to me, that 3 of the top 4 are the cities that you saw in the previous chart, the cities losing the most population: Los Angeles, Chicago, and New York. And then you've got Miami, which apparently has a problem in this regard, San Francisco, Baltimore, Atlanta, Washington, Philadelphia, Sacramento. So this is a big problem. Fortunately, we haven't had this problem in Texas or in Arizona or Denver or most of the cities that we do business in. But this is I think a good example of why a lot of people are leaving some of these cities. They don't feel safe, and they're moving. They're voting with their feet, so to speak. I think it's an interesting chart from those that are most affected by all this crime. Then this gives you a little bit more. This next chart, population growth by MSA. We had focused on population loss or migration increases in the earlier chart. This is just total population growth. That you can see that Austin, Texas, which is just incredibly active right now, grew by 33, almost 34% in that 10-year period. And DFW had the Dallas-Fort Worth had the highest population growth in terms of numbers at the 1.3 million at about 21%. Houston followed that at 1.2 million. So this is where, there's a lot of growth in population. This is in migration. This is births over deaths. This is, everything that goes into the calculation of population growth. You can see at the bottom, again, we have our, LA, New York, Chicago. Chicago actually lost population, so did Pittsburgh in that 10-year period. LA had relatively minor growth, so did New York, so did Philadelphia, so did San Diego, San Francisco. I mean, they're for the reasons I discussed earlier, they're losing population, and the cities that we focus on, like Austin and Raleigh and Orlando and San Antonio, Dallas, Houston, Phoenix, they're all growing rapidly. So that leads to a shortage of housing. We have a shortage of housing in these high growth cities. One of the things that you need to be aware of when people talk about housing in the United States, a lot of them speak in terms of national numbers. Oh, starts are down, or houses, sales have slowed down, or whatever. On a national basis, you have to disregard the numbers. You have to look below the national numbers to the local numbers. And that's where you get into what we could, the high growth cities that we focus on, where there's a lot of growth. Housing starts are increasing, and apartment construction is very high. I got a couple things yesterday that aren't on the slides. But for example, in Austin, in 2021, they built 11,000 apartments. Sounds like a lot. Well, they absorbed 21,000 apartments in Austin in 2021, because there was quite a pipeline of apartments. The occupancy rate in Austin is over 95%. There's an analyst that we follow out of the Wharton School, Pennsylvania. He's projecting that the vacancy rate in Austin at the end of 2024 will be 2%. Rents in Austin last year, I believe it says here, went up 22%. Now that's quite an incredible number. Now, most of the cities that we do business in, rents went up 22% year over year rent growth in 2021. And this analyst here estimates a 10% year over year rent growth in 2022. Still very dramatic. San Antonio, very similar story to Austin, although San Antonio isn't as robust as Austin is, but it's still strong. They produced 4,200 apartment units were constructed in 2021, and they absorbed almost 12,000. So it's and the rental growth was, I believe, 12%. Let me look here, 14% year over year rent growth. So what you have happening in the cities that we do business in is rents are going up and cap rates are going down, are being compressed, which is a great formula since costs are going up. We see a lot that the cost of construction of apartments has gone up quite a bit, but that increase in cost is more than covered by the rent increase and the compression of cap rates. Apartments in Texas, in the major cities, new apartments are trading at 4 caps and below, and people are buying, at these rates because it is expected that rental rates will continue to go up. Probably not at 22%, but at some double-digit number. The apartments, and I don't know, I can't speak to the situation in Canada, but here apartments are not the preferred zoning. It's difficult to get apartment zoning in a lot of the cities. And what we focus on is 3-story garden apartments in the suburbs. We do some high rises in Florida and a couple other cities, and in Canada, of course, we do high rises, finance high rises. But in most of the cities that we finance in Texas or in the Southeast and Southwest are either 3-story garden or the horizontal 1-story horizontal apartments that I mentioned. So you can see the growth numbers. Then we have another, go to the next page, please, page 7. This is an interesting one. No, growth by state, next one, page 7. Okay, now this is most of the states that we do business in, and it compares to the US population growth. And you can see at the bottom line, the bottom two lines, the most interesting to me is what's the projected population growth from 2021 to 2026. And you can see that all of these cities and states, with the exception of California, are significantly higher than the US in general. Many of them are double the US number. So population growth is projected to continue in these states, and these are the cities that we do most of our business in: Texas, Arizona, Colorado, Utah, Nevada, Georgia, Florida, North and South Carolina, and Tennessee. We do a little bit of business in California, but not much. But I put it in there for illustrative purposes. And then the next one, there's some bar graphs to illustrate it further. And you can see that the states in which we do business, it's this pie chart on the right, states where we're active make up 68.5% of net projected US population growth from 2021 to 2022. And you only have 10 states there. So it's, and you can see what the other states are 1.99%. And with the exception of California, which is again a laggard, you can see that all of our others are double or more than, almost double or more than double what the US average is, and certainly more than the other states at 1.99%. So the growth story is compelling and will, in our opinion, continue. Now, one of the things that's happening is it's a supply issue, as you might imagine when you have all this growth. For example, on single family lots, most of the cities in which we do business, equilibrium on vacant developed lots. That means that there's a balance of supply and demand, and lot prices should be stable and shouldn't be going up very much. And lot prices drive housing costs, as you might imagine. So one of the big elements of the cost of a house is the land. So equilibrium is considered to be 24 months. In Dallas right now, there's a 14-month lot supply, vacant developed lots on the ground. And it's going to take, and that's a similar number to virtually every city that we do business in. Somewhere in the mid-teens is the lot supply. It's going to take years to catch up to get to equilibrium in these cities, because there's only so much labor and there's only so much materials, and you can only put them through the system with the city so fast. So it's going to take years to get into a balanced supply and demand. Lot prices are going up, which is beneficial to us because that's beneficial to our developers who borrow money from us. And builders are desperate for lots, because a builder without lots is not a builder for very long. So they are, very competitive to position themselves for lots. All the builders, of course, want to grow, particularly the public builders, in order for their stock price to increase. So it's a real fight to get lots, and it's going to continue to be that way for quite some time. Also, on the apartment side, occupancy rates are typically 95% or higher, and rent, as I mentioned, is increasing at double-digit rates in every city that we do business in. Now, go to the next slide, slide 9. Now, the housing shortage is permanent, is the opinion of an economist that prepared this slide, named Mark Dotzer. And he shows here single-family housing starts since 1959. And you can see that, well, it highlights in 1965, we had a population of 194 million. In 2021, we had a population of 332 million, and we're not producing as many starts as we did in 1965. So this just, again, shows you where we are in terms of a shortage of housing in the United States. We went for a long period after the recession, the Great Recession, not producing enough houses. Our population is growing, and in the cities that we, particularly in the cities we do business in, and it's creating a severe shortage of housing. Again, that's another thing. You might hear, read, oh, the United States population growth is slowing down, household growth is slowing down. Well, that's true on a national basis, but it's not true in the cities that I've highlighted, in the states that I've highlighted, because population obviously is growing very rapidly there, and so is household growth. One of the things that's driving the home building business right now is the millennials are buying houses. People are they're buying houses later than people did previously, but they are now buying them. So the demographics are very favorable for single family. And then go to the next slide. This just shows that household debt service payments are very low by comparison to prior years, particularly during the Great Recession for most, in the middle bars there. And the next one, household net worth has gone up significantly. And this plus the prior chart is indicative of the fact that people have more ability to buy houses. They're not as indebted and they have more net worth. And then the last one is job openings in America. Everybody's looking for workers. Salaries are going up. Of course, we have a problem with inflation right now, but that's manifesting itself not only in a price increase of houses, but salary increases. And there was a movement several years ago to get to a $15 minimum wage on a national basis. That law was never passed, but in reality, I think we're there. A $15 minimum wage, if not higher, in most of the cities in which we do business, because there's such a shortage of people to fill jobs. So I think Spencer mentioned that we're doing more in equity now than we did previously. We started 5 funds that we call TOF funds, Trez Opportunity Funds 1 through 5, and they've done exceptionally well. And we're going to start up TOF 6, which will have some apartments in it, and which will have some apartment construction, and we'll have some lot development. We are partners in many of our lot developments that we've invested equity in with Hines, Hines, not the ketchup people. They're one of the larger developers in the world, and we have a great relationship with them, and we've done over 20 partnerships with them over the years, either in lot development or in self-storage. Those TOF funds were limited duration funds for 5 to 7 years of life. And we've started up one now called TPREF, which is an open-ended fund, which has no limited time period on it. And it will be involved heavily in residential. We have going into that fund, build for rent houses that we're going to buy and rent, and ultimately aggregate several thousand houses and sell them to these big funds that have been formed to own homes and rent them. Some Wall Street, some of these, they own 100,000 houses around the country. We're gonna build them entire neighborhoods of rental houses and then eventually sell them. We have apartment construction. We have 3 apartments projects under construction now, with another 6 or 7 to go. We have lot development projects with Hines. We bought one project in Austin with about 3,500 lots that will be developed, and another one in McKinney, which is north of Dallas, which will have about 700 lots. And then TPREF owns 14 self-storage facilities around the city of Dallas. We consider that to be very related to single family or to residential, because people need a place to store their goods, their stuff. Small businesses need a place to store things. And in Texas and in Arizona and most of the states that we do business in, they do not build basements in houses, in new houses. So people have to fill if they're going to store things, they fill up their garage, and then they have no place to park. So self-storage is a very popular item in these high growth cities. And the cities themselves don't like to zone for self-storage for whatever reason. They look at it as some use that they would prefer not to have, but they have to allow some. So once you get zoned, you've got a little bit, some barriers to entry for others to compete with you. So we own 14 projects. They're doing very well, and we plan on either building some more or buying some more. So TPREF is off to a very good start, and money's not lying idle, and we expect that to do very well. And I invested a significant amount of own personal money in that, and so did Morley. I've invested in all the top funds, and so has Morley and most of our senior management. So that's the story. It's about growth. Growth is continuing. Interest rates have not slowed. The increase in interest rates have not significantly slowed down home sales. Now, let's talk about that for a moment. They say that home building is supported by a three-legged stool of consumer confidence, job growth, and interest rates. And right now, in most of our cities, consumer confidence is pretty high because people are employed, they're getting raises, and it's easy to find a job if you want to work. So, and unemployment is very low. The interest rates are going up a little bit, but there's a lot that can be done to facilitate sales of homes. Right now, builders' margins on their houses are very high. They could provide some incentives to people to help them qualify for mortgages. People could shift from 30-year mortgages to a variable rate mortgage at 3 or 5 years and get lower rates. Back when I was in the business, we used to buy down rates for customers, and there's a lot of things that can be done if rates become a problem, but none of the consultants and economists that we deal with think that it will be a problem. And as long as it doesn't get above 4%, I think we'll be in very good shape. So that's my comments. And I'll take questions from anybody that would like to ask any.
Well, that was great, John. I really appreciate your comments. We do have a few questions here. Well, before I even jump into the questions, I liked one of the notes that you made in regards to media, talking about the national performance in the real estate market, and obviously by some of the slides you shared, that those national numbers mean very little when you start to dive down into the individual, more local, I guess, real estate markets. So it's really cool to see those things and see where you can find performance, and instead of looking at it on a national level, look at it very pinpointedly to search for areas of performance. So it was great sharing those slides. We really appreciate it. But in terms of questions, I know, some people, when they think of the real estate market, can harken back to 2006, 2007, when it was just a nightmare out there for the real estate market. How do you compare today's environment to that 06, 07 timeframe? What's it look like in comparison to that?
It's very different. In 06, 07, 08, and 09, I was in the home building business. I left Ryland at the end of 2009. It was an effort in our country to increase home ownership. It started with Bill Clinton. It picked up speed with George Bush, and then Barack Obama. And it was well intended, but it was not well planned. And there were a lot of, you might have heard the Ownership Society. This was a bipartisan screw up. It wasn't either Republicans or Democrats. They both bought into this whole theory of ownership society. The problem was that people were buying houses that were ill suited to own them. They didn't have savings. They were one car break away from not being able to pay their mortgage. Look, I've always admired Canada for your discipline in your market. I mean, in your financing of homes, it seems much more disciplined than we used to be. We're more disciplined now, and that's one of the reasons I don't expect what happened back in 2006 to happen again. But back then, you could buy a house really with no money in it at all. The home builders would be able to pay your closing costs, but they could pay all your closing costs. But what they couldn't do was they couldn't provide your down payment. And back then, the FHA, to get a government mortgage, you had to put down 3%. And the some genius came up with this idea of a down payment assistance program. And the government endorsed this. And this was one of the things that created such problems. If I'm a home builder and I want Mrs. Smith to buy a house, I can't give her 3%. Let's say the house was 200,000. I can't give her $6,000. But somebody created this fiction. They created a nonprofit organization called the Nehemiah Fund. I could give the $6,000 to the Nehemiah Fund, and Nehemiah could give it to Mrs. Smith. It's crazy, but there were signs up all over the country. $1 move in. No, $1 move in. You could move in the house for $1. Well, you can imagine what that did. And you heard about liar loans and all this other nonsense that went in our country, where they were giving mortgages to people that had no business getting mortgages. They didn't have the financial wherewithal to qualify, but that people were all looking the other way. It was a lot of fraud. And that's what created the problem.
Well,
Now,
even mortgaging to 130%. In some states, you could mortgage up to 130% of the value of your property, which people would just go take on bigger homes so they could pay off their last property and then pay off their cars and the trip to Hawaii. And as long as the price of the real estate went up, they kept
it was crazy
up the hill. Yeah.
So now to buy a home, to get a mortgage, I should say, is much more difficult. They underwrite very strictly. They do not cut all these corners that they used to. They used to have what was it called? No doc loans. If you put 20% down, they didn't do any investigation into you at all. And then it's kind of bled into, even if you don't put 20% down, we're not going to really look at your underlying financial situation. That's gone. There's a lot of discipline in the home mortgage business. Now, also back then, it was easy to get a loan to develop something. Banks were loaning non-recourse loans 90%, 95%. So the banks were taking inordinate risk and putting money out that shouldn't have been on properties that shouldn't have been developed because the developers didn't have much risk or any. So they were that led to overdevelopment. Now today, to get a non-recourse loan at a bank, you will not get more than 65% of the cost of the development. And if you can get, and you have to sign a completion guarantee and a carve-out guarantee. So there's no such thing as a totally non-recourse loan anymore in the United States. And the banks are under extreme scrutiny, and that's not going to change. They're not loosening up most of their rules. There are some banks that have gone up a little bit higher on the capital scale, but not nearly what they've done before. And if they're not careful, then there's buckets too now. The banks, if you can loan out $1 billion, let's say, you can't put it all into one thing or another. The regulators say, well, you can only have so much for your capital in this bucket, let's say home building, in this bucket, say apartment construction. And once you reach your limit, you have to stop lending out of that bucket. So there's all these rules that were created after the recession that are keeping things in check. I mean, it's not like it was, and I don't expect it to happen again, anything like that. Now, when I was in the business, there were recessions, but not, previous to the Great Recession, let's say after 9/11, there was a recession. And what would happen in the home building business is, let's say builder was supposed to buy 10 lots a quarter from the developer, and the developer would then use that money to make its payments on its loans. Well, the builder might go to the developer and say, look, my sales have slowed down. I can't buy 10, I'll buy 7. Developer goes to the bank or whoever the lender is, says, look, my builder can't make its full purchase, but he'll buy 7 lots, and will you reduce your principal payment requirement? So that's what typically would happen. So you'd work through the deal. It might take a little longer for all the lots to be absorbed and the loan to be paid, but it did not end in disaster. Now, with the Great Recession, there were a lot of disastrous deals because they were overbuilding, and houses were built that shouldn't have been built, and there were lots that were developed that shouldn't have been. But that's not the case today. So I don't expect, unless there's some, who knows, I mean, black swan event that even, that no one can anticipate, but there's the characteristics of what created that recession don't exist today.
Well, that's comforting to hear. It's surprising that was 15 years ago. I still remember how shocking it was, how everything fell apart down there in your country around that. So it's great to hear your comments and your feedback around it. Being involved in it at the same time you had an inside armchair ride through that, I'm sure.
What I didn't realize was how much fraud there was back then. We were selling homes and we were making loans. We had a mortgage company, but we were disciplined. We didn't just give loans away. And they underwrote them pretty strictly, but there was a lot of fraud in the business going on. I mean, we disqualified a lot of potential buyers through our mortgage company, but a lot of them got loans somewhere else. I mean, so I was not aware of how much fraud there was going on, but it was an incredible amount. And I don't see that today at all. So
fraud is one thing that you never see until it's reared its ugly head, and there it is.
That's right.
You have to find it sometimes. You've spoken a lot about Texas and the massive growth that's being seen there. With your crystal ball, you look into the future. Where's the next Texas? Do you see another area of the country that's positioned to be in a high growth pattern like Texas has seen over the last 10, 20 years?
Arizona and Utah. Utah is...
Get your checkbooks out.
Utah is growing very rapidly. Phoenix is just incredible. What's going on in Phoenix in terms of job growth and house, the need for housing. We do a lot of business there with these horizontal apartment developers. We also finance, some lot development there, but most of what we do there is multifamily development. And the prices being paid for them for these apartments are just astronomical. And the increase in rents and increase in occupancy, it doesn't seem to be slowing down. And it can't go up 20% a year, and someday it will slow down. But cap rates are like I said, approaching. There's even some that have sold below 3%. And there's a lot of institutions that want to buy apartments and new construction, and that's really who the buyers are. I mean, I wouldn't buy one at 3% cap rate, but I'm certainly glad to sell them at 3% cap rates. These insurance companies and whatnot want to buy them, and that's who the buyers are. They're going into the hands of some very substantial entities.
You know what? One quick last question, then we're going to wrap things up. But I guess, you're speaking to where things are booming. I mean, California was the place for so many years, and it seems like they're losing badly. What's the outlook there, or will they be able to stem the outtide of people?
I don't think they care. I really don't. I mean, they're not doing anything to change. They're raising their taxes. They're not loosening up their regulations. Now the state is it has a big surplus. The state collects an incredible amount of taxes from Silicon Valley folks, particularly, and but they're going to be a barbell state. They're going to have a lot of poor people and a lot of rich people. The middle class is leaving. They can't buy a house. They don't like what's happening with crime. They don't like the taxes. So a lot of them are leaving and going to Arizona or Colorado or Utah or Idaho or Texas. And I don't. Now there's a book you might want to read if you're really interested in this Texas versus California thing, and it's called Texas versus California. And I think the author's last name is Miller. And he gets into, it's a very interesting book. He gets into the history of Texas, the history of California, how both of them came out of Mexico in one way or another, and how they evolved into what they are today, with Texas being the leader of the red states and California being the leader of the blue states. And it's a very interesting read. I'm about halfway through it. But it would give you a real perspective on what caused this, and in terms of where Texas is and where California is. Now, don't get me wrong. California still does. There's a lot of business in California. We're just very careful, very, very careful about what we do there. We only have ever financed a couple projects there, but it is very, very difficult to get zoning. So if you are able to get zoning for a residential project, you're probably going to be successful, just because they make it so difficult, and their fees are so high to get permits and things. So it drives up. They complain about affordable housing, yet they do everything they can to drive the price of housing up with requirements that make houses more expensive. So.
Well, John, we want to cut it off there. We want to thank you very much for joining us today. We have to apologize to you, our guest, as well as to our attendees today for the technical glitches we've had. It's almost been like a radio show, so it's been been fun. Sorry we weren't able to see each other and over the Zoom chat here, but thank you again very much for joining us, and thank you to our attendees for joining us. This has been a Tower Wealth Advisory webinar, and if you need to find us, you can find us at towerwealth.com or follow us on social media. Thanks again, John, for joining us, and Spencer as well.
Well, if anyone has any questions they want to send or call me about, please do. More than happy to help answer any questions you have.
That would be great. We'll forward questions through if any come our way.
All right.
Thanks very much.
Thanks a lot. Take care.
Bye for now.